In our modern world, we often think of money as something we can hold. We imagine crisp banknotes or shiny coins in our pockets. But what if money wasn't physical at all? This is the reality of digital currencies. They are a new form of money that exists only in the digital realm, as lines of computer code on a vast shared network. You cannot touch them or put them in a physical wallet. Instead, they live on our computers and smartphones, accessible through special applications. This idea might seem strange at first, but it is quickly becoming a normal part of our financial landscape. These currencies, like Bitcoin or Ethereum, are changing how we think about value and exchange in a globally connected society. The concept of non-physical money isn't entirely new. For decades, we have used credit cards and bank transfers, which move numbers between accounts without any physical cash changing hands. Digital currencies take this idea a significant step further. Instead of being managed by a central bank or a single financial institution, they operate on a decentralized system. This means that no single person, company, or government controls them. The network is maintained by thousands of users all over the world, who all work together to verify and secure transactions. This radical departure from traditional financial structures is what makes digital currencies so revolutionary and, for many, so appealing. It represents a shift in power from central authorities to a community of users. Think of it like a shared public notebook that everyone can see, but no one can alter without agreement from the group. When someone sends a digital currency to another person, the transaction is recorded in this notebook, which is often called a blockchain. This record is permanent and transparent, creating a system built on collective verification. Unlike a simple number in a bank's private database, which can be changed or manipulated behind closed doors, a transaction on a blockchain is secured by complex mathematics and the consensus of the entire network. This technological foundation is what gives digital currencies their strength and integrity, even though they lack a physical form we can see or feel. The rise of these currencies is a direct response to our increasingly digital lives. We shop online, work remotely, and connect with people across continents in an instant. It only makes sense that our money would evolve to match this new reality. Physical cash can be slow and cumbersome for international transactions, often involving high fees and long waiting times. Digital currencies, however, can be sent across the globe in minutes, with minimal costs, directly from one person to another. They are designed for the internet age, offering a borderless and efficient way to handle finances. This convenience is a major reason why more and more people are starting to see them not just as a technological experiment, but as a practical and powerful tool for the future of money. For something to be considered money, it has to do more than just look valuable. It must fulfill three very specific and crucial jobs that economists have identified over centuries. The first and most important job is to act as a medium of exchange. This means people must be willing to widely accept it as payment for goods and services. If you want to buy a loaf of bread, the baker must be willing to take your money in exchange for it. This universal acceptance is what makes commerce possible. Without a common medium of exchange, we would be stuck in a system of barter, trying to trade chickens for shoes, which is incredibly inefficient and complicated. Money solves this problem by providing a single, trusted item for all transactions. The second essential quality of money is to serve as a store of value. This means that the money you hold today should still be worth roughly the same amount tomorrow, next week, or even next year. It needs to hold its purchasing power over time, allowing you to save for the future with confidence. If your money rapidly loses its value, people will not want to hold on to it, and it will fail as a saving tool. This is why things like fresh fruit would make terrible money. They spoil and become worthless very quickly. Good money, whether it's a gold coin or a modern dollar, must be durable and resistant to decay, ensuring that the wealth it represents is preserved for when you need it. The third and final job is to function as a unit of account. This simply means that money provides a common measure of value, allowing us to put a price on everything in a consistent way. It gives us a universal yardstick to understand how much something is worth. For example, we understand that a car is worth many thousands of dollars, while a cup of coffee is worth only a few. This allows us to compare the value of different items, make budgets, and keep financial records. Without a standard unit of account, it would be nearly impossible to run a business or manage personal finances. Money creates a clear and understandable language for economic value that everyone in a society can use. These three functions, medium of exchange, store of value, and unit of account, are the pillars that support any successful form of money. Throughout history, many things have been used as money, from seashells and salt to precious metals and paper notes. Each one succeeded or failed based on how well it performed these three essential tasks. When we evaluate new forms of currency, like the digital ones emerging today, we must measure them against these same timeless standards. The real test is not what the money is made of, but whether it can reliably serve these fundamental economic purposes for the people who use it in their daily lives. Now, let's see how digital currencies stack up against the traditional rules of money. First, as a medium of exchange, they are gaining incredible ground. A growing number of businesses, from major tech companies to small local cafes, are beginning to accept cryptocurrencies as a valid form of payment. The process is often as simple as scanning a QR code with a smartphone. This ease of use makes digital transactions fast and efficient. Furthermore, for international trade, they are a game changer. Sending money across borders can be slow and expensive with traditional banks, but a digital currency transfer can happen in minutes for a fraction of the cost, connecting buyers and sellers anywhere in the world with unprecedented ease. When it comes to being a store of value, the picture is more complex but still promising. It is true that many digital currencies are known for their price volatility. Their value can go up or down very quickly. However, many supporters argue this is a sign of a new asset class finding its footing. The core technology of many cryptocurrencies, like Bitcoin, includes a fixed supply. This means that unlike government-issued money, which can be printed indefinitely and lead to inflation, there will only ever be a certain number of digital coins created. This built-in scarcity is a powerful feature that can, over the long term, help it preserve value against the threat of inflation, making it an attractive option for saving. Digital currencies also excel as a unit of account. Every digital currency is divisible into very small fractions. For instance, a single Bitcoin can be broken down into 100 million smaller units, known as satoshis. This incredible divisibility makes it easy to price goods and services of all sizes, from a multi-million-dollar property down to a digital song that costs less than $1. The value of any item can be expressed precisely, which is crucial for clear accounting and commerce. As more goods and services are priced directly in digital currencies, their role as a clear and consistent yardstick for value becomes stronger and more established within the global economy. In essence, digital currencies are successfully ticking all the boxes required to be considered real money. While they are still a relatively new technology and are evolving rapidly, they have demonstrated their ability to function effectively in all three key areas. They are being used for exchange, they offer unique properties as a store of value, and they provide a precise unit of account for the digital age. Their design is a direct response to the needs of a global, internet-based economy. As they become more stable and widely adopted, their position as a legitimate and powerful form of money is only set to grow stronger and more influential in the years to come. One of the biggest questions people have about digital currencies is why anyone should trust them. After all, they are not backed by a physical commodity like gold, nor are they issued by a government that promises to honor their value. The answer lies in the technology itself. Trust in digital currencies comes not from a central authority, but from mathematics and a shared, transparent process. The underlying system, the blockchain, is built on complex cryptographic principles that are incredibly difficult to break. Every transaction is verified and agreed upon by a network of thousands of independent computers, creating a consensus that is far more resilient to fraud or manipulation than a single centralized database. This decentralized nature is a powerful source of trust. In the traditional financial system, we are forced to trust intermediaries like banks and payment processors to handle our money correctly. However, history has shown that these institutions can fail, be hacked, or even act against the interests of their customers. Digital currencies remove the need for this kind of blind trust. The system operates on a set of rules embedded in its code, which are visible to everyone. The trustless environment it creates means you don't have to trust any single person or entity. You just have to trust that the mathematics and the open source code work as designed, a fact that can be independently verified by anyone with the technical knowledge. Furthermore, digital currencies give users unprecedented control over their own funds. When you hold cryptocurrency, you are your own bank. You possess the private keys to your digital wallet, and without them, no one can access or seize your assets. This is particularly empowering for people living in countries with unstable political or economic systems, where bank accounts can be frozen or savings can be wiped out by hyperinflation overnight. For these individuals, digital currencies offer a safe haven, a way to protect their wealth and transact freely, without fear of censorship or government interference. This level of financial sovereignty is a core reason why so many people are placing their trust in this new form of money. Ultimately, the success of digital currencies proves that money is, and always has been, a social construct built on collective belief. We accept paper money not because the paper itself is valuable, but because we all agree that it is. Digital currencies are winning the money game because they have successfully created a new foundation for that collective belief, one based on technology, transparency, and user empowerment. They have met the classic requirements of money, while offering solutions to the modern problems of a globalized world. As more people understand and embrace this new system, the trust in these invisible numbers on a screen will continue to solidify, cementing their place as a dominant force in the future of finance.